For more on the markets, let's bring in Marta Norton, Chief Investment Strategist at Empower Investments. Good morning. And just to lead into this, Marta, you make some interesting points that the Trump trade and the soft landing trade, there was a great deal of overlap. So it's not surprising that post-election we've seen a continuation of what the market was doing prior to the election.
That's right, Joe. I mean, I think you can think of it as a little bit of gasoline on a burning fire. What we saw really starting in, I guess I'd call it mid-September, that's when we really started to see the 10-year yield start to move higher. And I think that relates to the stronger economic growth that we saw pull in at around that time, really giving folks the sense of confidence in the soft landing. And of course, then we add the Trump trades into the mix. And of course, those encourage the 10-year yield as well, and also encourage the idea of stronger earnings growth through tax policy and the like. And so we just have a lot of forces pushing the market higher. And I think as we look forward, the question, of course, comes down to valuation.
That's what we have talked about quite a bit. What do you call it, 22? Some people, I guess maybe current year 23, but whatever it is, it's at the high end of historical ranges. You talk about the most recent earnings season that we went through. It was good, but not a blowout. So if there's no real multiple expansion possibilities, you don't want to use it to time your trades valuation. That never works, but it certainly should at least have you at least raising an eyebrow that we might be expensive.
Yeah, exactly right. I think there's kind of a push-pull here because there's less of a possibility, I would imagine, for multiple expansion, just given to your point where things stand today. And yet, as we look at the economy, there's a lot of reasons to think the economy is in decent shape. There's reasons to think that there could be some earnings momentum when we look at potential tax policies, especially those that favor domestic producers. And so that includes some of the small caps and helps explain some of the rally there. It also includes some more consumer-oriented stocks. So it really supports this kind of broadening out narrative from an earnings growth perspective. And that's what you see actually in analyst earnings expectations for Q4 and into 2025. So there's going to be this push-pull, I guess, between what we can expect from an earnings growth perspective and what we can expect from valuation. And with that push-pull, I would argue that it's important for investors to moderate expectations, given that we've had 20% plus years in the past 2 years of returns.
So next year sounds like one of those 7 to 8% years, including dividends?
I think there's an argument for that. I mean, it's certainly hard to imagine a third year of the returns that we've seen. It's within the range of possibilities, but maybe not the most probable outcome. And I guess another point that I would make is it feels like 2025 is really a year for balance over conviction, because when you look across sectors, not only is the broad market expensive, and there are areas that are especially expensive, technology and financials, but it's hard to find screaming opportunities anywhere. You can make a relative valuation argument for small caps in other areas, but it's not as though there are these fat pitches that are coming out that people can take swings at. So I would caution for balance from here.
I don't know what you do to balance it then. Does that mean increasing the fixed income? I mean, would you increase duration? I don't want to go there either. So what do you do if you're not totally in love with the stock market?
Right. So, well, first, within the stock market, I think there's a little nuance that you can introduce just when you think about a market cap weighted index and 30 cents of every dollar in the S&P 500 going to the Mag 7, thinking about introducing potentially a little bit more small cap exposure, not a major, allocation, but balancing that out a bit. And then when you think cross asset and you're looking at fixed income, we're calling this a year for coupon clipping. So not necessarily seeing a lot of appreciation from maybe falling yields, but there are attractive yields within fixed income. So it's not necessarily moving out the curve, but having some exposure there.